It's defined by high resistance or low resistance. I'm teaching you, son, to learn how to read price action so that way you're trading and engaging with low resistance. That means you're not going to trade every day. If you haven't realized that yet, for the folks that are listening too, that means you're probably not going to trade every day. And that's not a bad thing. I have better things that I could be doing instead of worrying about having to be precise in a market condition that's going to rob you of precision. And it's going to beat you up by retracements more times than you want to see happen. So, my question to you in the live stream audience that are listening or watching it later on when it's appropriate for you to do so, are you more inclined to want to be in an environment like this where you have to worry about if you ever move your stop loss, you're probably going to get prematurely stopped out and never see the targets trade to before getting stopped out? Or would you find yourself more prone to seek opportunities where the market doesn't have so much of an interest that's vested in coming back and stopping you out prematurely because you're in a low resistance liquidity run condition market where it just moves real free and loose and it just goes right to target like it's in a hurry and has something to go and do something else. That's what you want to be trading in, Caleb. That's the market conditions you want to trade in. And they have very simplistic characteristics that it indicates before the market trading day starts. And it's defined by high resistance or low resistance. And it's very easy to notice it. Even if you don't expect it, but you start seeing signatures in price action, how it's behaving, where every individual candlestick is overlapping the previous candlestick's range by the majority. That is indicating the clearest, most visual clearest, most visual representation of a high resistance liquidity run condition is every subsequent candle is sharing the previous candle's range. That's a very simple definition, isn't it? Versus a low resistance liquidity run condition is the candlesticks are a lot more separated between their highs and lows, and they're not sharing much of the same range of the previous candle. It is a lot of big candles, and that's exactly what you want. You don't want to be in here waiting around forever for your target to get met. You don't want to be waiting for the spread to overcome and move into a position of unrealized profit and holding on to that throughout the entirety of your trade. I don't want to be in trades where I have to wait for my trade to come out of spread or initial drawdown. I don't want to be in trades like that.